Hello and welcome everyone to Almus Market Mornings, your daily dose of global financial updates. We recently had the US inflation expectations number, which seems to have cooled off to 6.2% in July from 6.8% in June. We are also seeing oil trading below $100 a barrel. Now, these are some of the updates. Now, going into the day today, we have the US CPI numbers, which can trigger some sort of move. CPI numbers are widely tracked and widely followed by the markets. JK, please break it down for our viewers. What kind of print can trigger larger moves and what's the market expecting?
Okay, good morning. So after the blow-up jobs report on Friday and the initial reactions, actually markets have been quite range-bound, particularly in the currencies and the bonds. And we keep assessing the extent of rate hike by the Fed, although currently priced at 0.75% hike in September. But many economic indicators are looking weak. GDP came negative for 2 quarters, which is read as a technical recession. And yield curve inverting very steeply now. Doubts linger whether Fed will be as aggressive. In this context, the CPI number will definitely provide more clues. As food and crude prices have dropped in last 1 month, expectations for a lower number are justified, and the forecasts do actually indicate a much lower headline number at 8.7 versus 9.1 year on year and 0.2 versus 1.3 month on month. However, markets do remain cautious as these numbers surprise to the upside many times. And after proving the analysts' expectation completely off reality in non-farm payroll, we really hesitate to rely on these forecasts now. But yes, I expect a slightly lower number. In fact, in the lead up to the number, we had a big numbers. Inflation expectations across all time horizons. In fact, with 1 year at 6.2 from 6.8, 3 year 3.2 from 3.6. In fact, a 5 year also, which is at 2.3 from 2.8. So the drivers appear to be expectations of a sharp fall in price increases for gas and food, likely reflective of the decline in oil prices to the date. More secondary data, we had non-farm productivity declining at, declining at a 4.6% annualized rate, marking a second consecutive decline. In fact, the trend in productivity growth has worsened compared even prior to pandemic. At the same time, unit labor costs, the price of labor per single unit output has risen at 10.8%, following 12.7% rate growth in the first quarter, thus confirming increasing wage pressures. Another, secondary data, the IVD tip poll showed that 62% of US citizens think US economy is in recession. That's quite a big percentage, up from 58% a month ago and 53% in June, 48% in May. So after the recent strong rally, stock indices have hit strong technical resistance on charts, and the inability to build on the rally, despite good job numbers, adds to my view that what we have seen is a bear market rally and tighter financial conditions are likely to weigh on them again. It's no more evident than in the Nasdaq index that lost 3.5% in last 2 sessions, with the twin effect of downbeat reports from some tech companies and higher rates in prospect. The future direction for the markets don't look very promising, as central banks will be tightening more into the slowing economy, and that's important. And balance sheet reduction as well is increasing everywhere. Yields have maintained their upward trend post jobs data, but again, front ends are again more. I mean, the 2-year tenor. That is why you see the yield curve inverting further, now close to minus 50 bps. In fact, the yield curve, relative to 2-year is inverted all across the curve up to 30 years. Only it is, less and less as we go in the larger tenors. So it clearly means a huge uncertainty ruling over the medium-term prospects of the economy, as well as perception that perhaps a year from now, Fed may actually be cutting rates. The greenback has given some of the NFP-driven gains with recovery prominent in the euro, disappointing the bulls. Euro has shown little reaction to yet another bad headline in terms of the energy crisis, perhaps suggesting that quite a lot of bad news has been priced in. This was after Russia confirmed that crude oil flows through Ukraine to Hungary, Slovakia, and Czech Republic were halted because sanctions prevented payment of a transit fee. So I would like to see how the greenback reacts if we have a higher CPI number tonight. If we see an unimpressive performance in the dollar, one should conclude that the market is more concerned about the prospect of a recession, even as yields already seem to have topped out. Even if there is a higher prospect of 0.70% increase in the September meeting, I'm looking more at the terminal rate, which is not too far from 3.4%, which was predicted some time back. So market has an idea of how far the Fed will go, combined with the fact that the inflation expectations in the Michigan survey, rather the New York Fed survey has come down, should see dollar not gaining so much. So that's the reason why we are seeing dollar actually in a range after the NFP data as well. We are shifting focus to other countries. ECB likely to hike by another 0.5% in September. Peripheral bonds have been much calmer after some people attribute it to adoption of the transmission protection mechanism, which gives ECB some more relief to raise rates further. UK will, of course, be raising rates further this year, but the expectation is that they will be cutting in 2023 as economy will slip into a recession as the BOE forecast. More interest for me is in Japan, where after the recent cabinet reshuffle, Shunichi Suzuki is set to be retained as the finance minister, with some speculation that they could move to give up the yield curve control. Rupee still shows a greater bias to weaken on bad news, and markets debated whether the fall to 78.50 last week ended the correction. Fall in crude prices, steady stocks, and resumption of FI flows haven't had much impact on the rupee, and importers continue to buy on the dips. But we do feel RBI will remain consistent in their intervention, particularly if the dollar index does not rally too far. And 79.80 is a level that I would be watching to see if rupee weakens further, particularly after the CPI number. Just to touch upon the Taiwanese situation, the border tensions are still simmering. China's military announced new exercises near Taiwan on Tuesday, with Beijing clearly trying to deliver a message of displeasure following Pelosi's visit to the island. Taiwan said China's military actions violated the island's right under the international law, but that Taiwan would remain calm. So there's a sense that it's unlikely to get escalated into actual attack, etc. That's why the markets have been calm, but cannot take the eyes off that zone. So that's it. So a lot to look forward to from here now till Friday. We have CPI number, as I said, in the US today. Then we have UK GDP tomorrow. We have India CPI on Friday, as well as the Michigan preliminary survey for the US. So hopefully markets get better active compared to the last 2 days. Thank you.
Thank you, JK. And as JK mentioned, any adverse print in CPI, it can trigger some moves in the markets, or if it's unimpressive, then we really need to look at how the dollar index performs post that. So it's important to manage these kind of events with good risk management practices. That's it from our end. We'll see you all tomorrow with the latest updates. Thank you.